The first quarter of this year was the worst for stocks in 4 years, after war broke out in the Middle East in March. As equities collapsed, bonds and gold sold off as tensions rose. Traditional diversification failed completely. But now, just 2 months later, markets are back at all-time highs. So what exactly happened? And more importantly, what did March action uncover about how markets really work? In this video, we are breaking down the 4 strategic tensions that emerged from the volatility, not as a retrospective, but as a framework for understanding what drives markets when the usual playbook breaks. In fact, it's a perfect case study in how supply shocks act differently from demand shocks, how valuation and fundamentals can diverge, and how market dynamics expose what's hiding behind the headlines. These tensions weren't erased when markets recovered. They're structural forces that will return. Understanding them now can separate strategic investors from reactive ones. Let's start with the tension that had everyone asking if we were headed back to the 1970s. Tension 1. Inflation versus growth. What happened? The Strait of Hormuz closure took 10 million barrels per day offline. Oil spiked above $100. Energy prices surged 60% in weeks. And suddenly, stagflation wasn't just a history lesson, it was a headline risk. 2-year inflation expectations jumped 43 basis points in March alone, hitting 3.25%. Markets were pricing in more inflation just as they were getting concerned about the impact on growth. But here's what was missed in the panic. Energy's structural weight in the economy has changed over the years. Gasoline is now 2% of household spending, an 80-year low. In the 1970s, it was 3 to 4%. For an $85,000 household, even a 35% gas price spike adds $600–800 annually. While that might well be a significant burden for many people, is it going to be a crisis that wrecks the economy? The data says no. Household balance sheets entered this period at their strongest levels since early 2022. Net worth was almost 800% of disposable income in Q4 last year, which was only higher 3 times going all the way back to the 50s. What we learned: frameworks matter more than just the headline. Not all inflation shocks are going to impact the economy in the same way. Making comparisons to the 70s was weak analysis, ignoring structural changes in how energy is now consumed and how it fits in modern household budgets. What to watch going forward? Oil has continued oscillating around $100 in volatile trading. The key question now isn't about price. It's whether repeated inflation shocks start to dismantle longer-term expectations. The Fed is on hold for now, but internal divisions are growing. One of the things we'll be watching is the 5-year forward break-even rate, which is the market's view of where inflation will be in 5 years' time. You can find it on the St. Louis Fed's website, and if that remains fixed around 2 to 2.5%, the Fed has room to be patient. If that starts to rise, then everything changes. The Fed would understand that it's not just a temporary blip in prices and would have to think about raising interest rates aggressively to snuff out inflation, essentially forcing a recession to kill off inflation, bringing a stagflation scenario back on the table. Tension 2, tech valuations reset, while earnings are set to surge. What happened? The technology sector fell into correction territory in March. The Nasdaq dropped over 10% from its February peak, and after a 3-year bull run, the sell-off felt like a reckoning. But beneath the surface, something unusual was happening. Tech's valuation premium over the broader market hit a 7-year low. At the same time, earnings growth estimates for the sector pushed past 40%. That's up from 30% at the start of the year and nearly double 6 months ago. Let's think about that for a minute. Share prices of some of the biggest US tech firms crashed on the Iran sell-off, while their fundamental outlook drastically improved. The sector got cheaper as its potential for earnings power accelerated. Skepticism around AI spending hadn't gone away. Hyperscalers are deploying over $600 billion this year for infrastructure build-out, consuming 94% of their free cash flow. But on every earnings call from the likes of Microsoft, Google, and Amazon, it's the same story. Demand for AI compute capacity power is massively outstripping supply. They aren't constrained by the ability of customers to pay, but only if they can physically build enough infrastructure to meet demand. What we learned: Corrections in high-quality assets where earnings are rising faster means opportunities, not a reason to panic. The March sell-off wasn't fundamentals deteriorating, it was sentiment repricing geopolitical risk. Investors who recognized the setup added to positions at prices that won't be available again. Those who sold on fear missed the recovery to new highs. The lesson: when price and fundamentals move in opposite directions, pay attention to quality assets with pricing power and visible revenue traction. What to watch going forward? Mid-April tech earnings for the first quarter backed up the 42% growth trajectory. Companies were more confident in their outlook, with revenues especially strong in semiconductors, enterprise software, and industrial beneficiaries of the data center build-out. July earnings will offer the next test, and another positive round could make the March lows seem like a gift. Looking beyond revenues, gross margin trends and capex to revenue ratios are the key indicators that will tell us if the spending cycle is self-sustaining. Tension 3. Diversification breakdown. What happened? The 60/40 portfolio offered zero protection in March. In that 1 month, stocks fell over 5%, bonds fell nearly 2%, and gold slumped 12%. Traditional diversification failed completely. But this wasn't a fluke. It was the predictable behavior of assets during supply-driven inflation shocks. When inflation rises due to disruptions in supply, 20% of the world's oil in this case, bond investors demand higher yields to compensate for loss of purchasing power. Higher yields mean lower bond prices, so bonds fall alongside stocks instead of providing the usual hedge. Compare that to the 2008 financial crisis or the pandemic. When the economy weakens, causing demand to collapse, investors flee to bonds. The Fed cuts rates, which brings yields lower, so bond prices rise. That's when traditional asset diversification works. But March was different. This was a supply shock, not a demand shock, which dented sentiment for fixed income. Treasury auctions in late March drew the weakest demand in nearly 2 years. The 10-year yield rose nearly 0.5%, sending prices lower while stocks fell. That's the opposite of what's supposed to happen. What we learned: the 60/40 playbook works for demand-driven recessions, but it breaks during supply-driven inflation spikes. Recognizing which type of shock you're facing determines whether traditional diversification will protect you. So, what actually worked for defense in March? Real assets and commodities performed well, with energy the only S&P sector that gained amid the chaos. Companies with pricing power also advanced. Cash alternatives helped maintain optionality, and shorter duration bonds that are less sensitive to inflation fears than long duration did better. In this environment, a more defensive approach to equity allocations can provide more safety. This could include consumer staples for their steady demand and pricing power, utilities for stable cash flow and reliable dividends, and healthcare, which benefits from non-discretionary spending strength from retired baby boomers. What to watch going forward? Bond markets have shown some stability, but oil remains highly volatile and headline-driven. It's been a lesson learned. Defensive positioning needs to anticipate shocks on both the demand and supply side. Watch the relationship between the VIX index, which measures equity volatility in the options market, and the MOVE index, which does the same thing for bonds. When both spike together, that's an indication you're probably in a supply shock environment where traditional correlations disconnect. Traders also like to keep a close eye on commodity volatility. Supply shocks announce themselves through commodity price action long before they show up in official inflation data. Tension 4. Binary geopolitical outcomes. What happened? Investors processed the situation in the Middle East, very much in black and white terms, generally swinging between the optimism of a quick resolution or fears of a prolonged conflict. The Strait of Hormuz was severely choked in March, with some 10 million barrels per day taken offline in the largest energy supply shock in history. Major disruption continued into April, but markets didn't attach a permanent additional cost for the extra risk. Instead, prices jumped between fear and hope as the headlines shifted. Here's what was unusual in the background. Small caps outperformed the broader stock market. The Russell 2000 gained over 0.5% in Q1, while large caps fell more than 4%. This divergence was a critical signal. Small caps are more sensitive to the domestic US economy and less exposed to global supply chains and international risks. When they hold steady during geopolitical stress, it suggests the sell-off is sentiment-driven rather than breaking fundamentals. And that's exactly what played out. Markets recovered because the underlying economy was intact. The sell-off was risk premium repricing, not economic collapse. What that really means is that investors wanted additional compensation for taking on assets during that uncertain period. What we learned, instead of focusing on headlines, savvy traders were watching market internals, which is another way of saying they were following signals that come directly from the stock market. In this case, the market was telling us that small caps were resilient during a crisis, so fundamentals are intact beneath the noise. Geopolitical events create volatility, but they don't tend to break secular economic trends. The investors who focused on valuations and fundamentals rather than trying to trade the news cycle were far better positioned. What to watch going forward? The Middle East situation remains unresolved. Oil continues to bounce around $100. Defense spending is accelerating, with Congress looking at $50 billion in additional funding, which all points to more instability and volatility for markets. But the framework holds, provided domestic economic fundamentals remain strong in terms of employment, consumer spending, and corporate earnings. So geopolitical volatility creates a buying opportunity rather than systemic risk. In addition to the relative performance of small caps, professionals will also be watching credit spreads, which have been fairly contained so far, indicating economic fundamentals are solid. Looking at the difference between what investors demand to hold investment-grade bonds and higher-risk, high-yield bonds is key. When this spread widens, that points to fundamental economic deterioration rather than temporary fears. Also look at how companies with diverse revenue streams and strong balance sheets navigate these conditions, because these are the companies that will perform well across different scenarios. Conclusion: what this means for positioning. So what do these four tensions mean for how you think about portfolio positioning going forward? First, recognize that not all volatility is the same. Supply shocks behave differently from demand shocks, and geopolitical events create different risk profiles to economic recessions. The playbook that works in one environment breaks in another. Second, focus on market internals over headlines. Small cap performance, sector rotation, and credit spreads. These signals often reveal what's actually happening beneath surface volatility. Third, quality and fundamentals matter more during uncertainty. Companies with pricing power, strong balance sheets, and diverse revenue streams perform well across scenarios. Trying to trade the news cycle is a losing game. And fourth, corrections in quality assets with strong fundamentals create opportunity. The March sell-off in tech is the perfect example, with valuations resetting while earnings accelerated. That kind of setup doesn't last. These tensions haven't disappeared. Inflation concerns remain elevated. Tech valuations will get retested. Geopolitical risks persist. And the next market stress will break traditional diversification again. But now you have the framework to recognize what's happening and position accordingly. That's what market tensions is all about. Not predictions, not stock picks, but frameworks that cover multiple unfolding scenarios. Subscribe for monthly analysis covering the strategic tensions that drive markets. Full written breakdowns can be found on the Summit Crest Substack. Thanks for watching.